sense of the current world we live in, the study of history is the best place to start. Before launching into all things assets and liabilities, our journey starts as far back as 10,000 years ago, to a time and place where not even arithmetic existed. Then we will fast forward through many eras to where currency even takes on electronic forms. So whether you're here because you have a small business, want to start a business, or just manage your personal finances more effectively, you've come to the right place. Module 1 covers topics including the accounting cycle, key processes, accounting for cash transactions, and even creating a general ledger and trial balance. Module 2 builds on these concepts and delves into more details around assets, liabilities, and how to perform key reconciliations. This is really something to look forward to. You will really want to stick around for Module 3, where we touch on audits, internal controls, as well as budgets and forecasting, which are really important processes. And ending off in Module 4, where we really put annual financial statements under the microscope and look at each element, including how to make cash flow statements an enjoyable exercise. To get to grips with the basics of bookkeeping, so let's tackle Lesson 1. The objectives for today's lesson includes a brief but incredibly interesting history of accounting. We will touch on the double entry system, assess the difference between bookkeeping and accounting, and by the end of the lesson, you will understand what is an accounting framework and the different frameworks that exist. And being quite a practical, relevant subject, we will look at how bookkeeping principles can be applied in your daily life, even for a college student. Did you know the only word in the English language to contain 3 consecutive double letters are bookkeeper and its derivative words? How's that for a party trick at the next dinner? So welcome to the first topic in Lesson 1, where we take a quick stroll down memory lane to see how the field of bookkeeping and accounting was born and developed over time. It is interesting to note that the core function of accounting has in fact remained the same for many centuries. The crux of accounting is keeping a record of financial transactions, and this is still what is done today. Along with the need to keep track of the transactions was the need to be able to count, write, and use a means of exchange to which a value could be attached. In other words, a currency. And so the concepts of currency, arithmetic, and yes, even writing were born and developed right alongside accounting. So where did it all begin? The concept of exchanging goods spans many eras, starting over 10,000 years ago. In other words, the concept of bartering. Bartering has been modernized to take place online, where we exchange money for goods, but irrespective of the resources, the transactions need to be recorded and tracked. This need arose due to the increase in the volume of exchanges taking place. In ancient Mesopotamia, which is today's Western Asian area of Turkey, Syria, Iraq, and Iran, ancient accounting records were linked to the surplus and deficit of crops and herds. The earliest physical representation of bookkeeping used was clay counters or tokens. Symbols on these tokens were used to identify the resources exchanged. As the symbols became more diversified, a different system for recording was born. The transactions were documented on parchment. Ancient Egypt was no exception. There, scribes with the title comptroller documented the royal belongings. And as time passed, and more wealthy and affluent ruling entities and families emerged, despite their differences, there was always, and still is, a common need to keep a record of one's wealth. Up to today, with exporting and importing, the economy, with the help of technology, enables mass trading on a global scale. With industrialization and many revolutions, accounting evolved to become more complex, as the underlying goal of any accountant is to ensure fairly presented, transparent financials. As accounting became more intricate, the need for trustworthy experts arose to the extent that Queen Victoria granted a royal charter to the Institute of Accountants in Glasgow, laying the foundation for the formally recognised accounting profession as we know it today. I always knew I had some blue blood in me. While you ponder on the fun facts of the past, let's take a break. Hopefully you're learning lots, so let's put your knowledge to the test. What was the first form of evidence of record keeping? Thankfully, today, you don't need to create your accounting records or even write them. With technology and accounting systems, keeping track of financial transactions to the lowest level of detail is a breeze. However, the more archaic method used was clay tokens. They actually look artsy and interesting, so I guess that's how they coined the term creative accounting. And the historical fun doesn't end there. Let's take a look at the double entry system and its origins. He was dubbed the father of accounting. Italian-born Luca Pacioli described this form of record keeping in 1494 in a 27-page manuscript. The principles of this manuscript are still very much alive and used worldwide by bookkeepers and accountants alike. I am no science expert, but the double entry system is the accounting equivalent of Isaac Newton's third law of motion. I believe the law states that for every action, there is an equal and opposite reaction. Similarly, with the law of double entry, for every action, there is an equal and opposite transaction. Let's convert this into English. Basically, there are two sides to every transaction. In bookkeeping, this is called a debit and credit. It is just a term to help finance people understand what has increased and what has decreased. For non-accountants, if you think of your bank account, every time you splurge at a sale, your spending goes up. But unfortunately, the equal and opposite reaction is that your bank balance goes down. Another fancy term in the world of bookkeeping is ledgers. In accounting, ledgers are books where transactions are recorded. There are different ledgers for different types of transactions, and we will go into more detail on these throughout the module. For the last concept, known as the accounting cycle, Luca Pacioli's influence has stood the test of time. The accounting cycle comprises various steps in order to end up with a set of financial statements, but more on this in the next lesson. At the heart of it all, we have the process of bookkeeping. Literally, it means to keep the books, and I'm sure by extension, to keep the finance books in order. So on a day-to-day basis, bookkeepers will record every transaction of an organization through the use of journals. Journals comprise of debits and credits, which is the double entry system we just covered. So this is how the transactions enter the books into the various sub-ledgers and ledgers, which are maintained by bookkeepers as well. As the transactions originate from a source document for various regulatory purposes, these source documents will need to be stored in an orderly fashion for ease of reference later. And with every transaction, there will eventually be a flow of cash. This process can also be managed by bookkeepers, and again, the source documents such as invoices need to be filed with the proof of payments for safekeeping. So overall, you can consider bookkeepers as preparers, here to look after the financial health of your business. So why then do we need accountants? Accounting is considered to be the language of business. And just like there are people in the world with a keen interest in learning French, German, or Italian, we thankfully have people interested in learning accounting. We need these experts to help with taking the financial information from the bookkeepers and classifying, summarizing, reporting, analyzing, and interpreting the data to simplify and make sense of the financial status of an organization. As you can see, each of these on its own is quite a skill, and therefore within the finance unit, there are even more specialized accounting segments such as management accountants, financial analysts, to name a few, to assist in these areas. Let's take another quick breather to absorb all that content, because it's trivia time. Can you remember what Luca Pacioli's contribution was to the accounting industry? It was a methodology used by the merchants of Venice, carefully documented in a 27-page manuscript in the year 1494. This system is still used today all around the globe and is known as the double entry system. Let's check in. How have you experienced the first part of your journey? I hope it has been nothing short of memorable, but you can look forward to the path continuing in the next lesson. So coming up in lesson 2, we look at the accounting cycle, some key accounting processes, the life cycle of a transaction, and end off with typical transactions you can expect to find across various businesses. I look forward to continuing with you on your journey to achieve healthy financial management in all areas of life. So see you in lesson 2. And along the way, you're going to acquire practical skills that you can use to beef up your resume. Already, I think you have a sense that the accounting industry is key to all parts of life, and I could not be more pleased to have finance fundies from all across the world join me in this space. The skills acquired throughout this module and the rest of the course are so valuable and highly sought after. The world becomes your oyster. By the end of this lesson, we will have covered the theory behind the double entry system and some pertinent definitions under the skill of understanding key concepts. In the preceding lessons and modules, you'll soon have the ability to record like a pro and the power to reconcile like a champion, as well as superhero reporting skills, policeman-like compliance abilities, and scrutinize financial statements in ways that would put Sherlock Holmes to shame. So let's not waste any time and continue on your journey with the next topic. So for the last and final topic, we will be looking at the different accounting frameworks. To understand why a framework would be important, you need to understand who are the users of the financial information. The main output and summary linked to the operations and financial details of any business is the annual financial statements. These statements are necessary first and foremost for the owners of the business to assess how well the business is doing. Do the numbers make sense? Should there be such a significant loss or not? It then helps in making decisions about the next year of operation to ensure that the necessary improvements are implemented. For larger organizations, the managers and even employees will need these statements again for interpretation and monitoring of the financial results. External stakeholders comprise investors who will use them to assess the financial health and sustainability of the business for investment purposes. Suppliers and customers will also have a vested interest in the books, and even statutory entities such as the revenue services for tax purposes and financial institutions in order to appraise businesses applying for loans. We touched briefly on what the stakeholders' interest will be, but some of the main purposes of the financial statements is to serve as a means of evaluating the financial performance of an organization. Investors will use financial statements to decide whether or not they want a piece of the pie, and owners would need to decide on the strategy to boost profits and ensure the sustainability of operations. So some may use them as a basis for planning in the next financial year, when drafting budgets and determining whether bonuses or even dividends will be paid. And last, but probably one of the most important uses of financial statements is to adhere to various legal requirements in order to continue operating in the next financial year and to avoid dreaded penalties. We've covered the what and the why, so let's discuss the how. How do we prepare and monitor the financial information of a business? We can use a generic structure referred to as an accounting framework. This framework provides the rules and interpretations that can be applied when recording transactions. In order to fairly present a transaction, it must be measured and recognized correctly. In other words, it has the correct amount and classified to the correct account, and then appropriately presented and disclosed in the annual financial statements, so that the users can rely on them for the various uses as mentioned in the previous slide. The accounting frameworks can be referred to as broad-based, as they are fairly generic to be able to easily apply them to most businesses worldwide. Can you imagine the mammoth task of identifying all the different businesses across the various industries and trying to incorporate blanket rules for all of them? So fortunately, there are tailored solutions referred to as an other comprehensive basis of accounting, which is not widely adopted but can be used in the instances of financial statements required for a very specific purpose. The widely adopted framework is called the International Financial Reporting Standards, or IFRS, developed by the International Accounting Standards Board, or the IASB. IFRS comprises very general principles, and it is mandatory in over 120 countries in order to streamline reporting, making comparisons between businesses a more efficient process. US GAAP, or Generally Accepted Accounting Principles, is only allowed as an alternative in the United States, and is a far more comprehensive rules-based framework for reporting and disclosures. The third, not-so-common framework is UK GAAP, developed by the Financial Reporting Council in the UK. These financial reporting standards were designed to address the requirements of UK company law. This course will focus on the International Financial Reporting Standards and the basics of bookkeeping. These skills are so versatile, you can apply them in every sphere of life. You will always need to be able to plan, organize, control, and analyze information no matter which career or task. And you can even apply them in managing your personal finances to help you make better, smarter financial decisions. Let's see how a college student would do just that. Let's start with the money coming in. Earning an income is key to being able to cover expenses. In this example, income is made up of a fixed monthly income of $1,500, financial aid of $500, and some other odds and ends of $250, perhaps from part-time work or an allowance from very generous parents. But in essence, this student's ceiling of affordability is $2,250. Once that is established, he or she can then determine how to allocate this to money going out. As a priority, tuition fees and textbooks need to be covered, being a total of $388 per month. So far, so good. There is still a surplus of $1,862, being total income of $2,250 less the semester expenses of $388. For the living costs, items such as rent, groceries, insurance, the repayment of student loans, and even entertainment are typical expenses you would expect to see on a monthly basis. This list, combined with the semester expenses, can be viewed as the monthly ledger of the student, reflecting all the transactions that took place. At the end of the month, a diligent student would then analyze their income versus expenditure to ensure their spending is on track. This can be done by collating all the transactions, summarizing them, and generating a report to help with the analysis. This is very similar to the exercise performed by accountants, who would take the transactions captured by the bookkeeper and then translate the information into user-friendly formats for stakeholders to review. So looking at our example, it would appear our student was slightly underspent. Based on the green portion of the bar, and they were successful in covering their fixed costs and essential costs, and even managed to squeeze in a haircut. And before we conclude this lesson, let's make use of Morpheus one last time. Enter your answers to this very easy true or false question. IFRS is a type of accounting framework. As a quick recap, accounting frameworks are important guiding principles to enable preparers of financial information to record and report the finances of an organization in a consistent and accurate manner. So this answer is true.